Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com. Today I have Elizabeth Yin of Hustle Fund coming to us from the San Francisco Bay Area. How's it going?
Good. Thanks for having me, Nathan.
Yeah, glad to connect. I think we chatted a long time ago when you were at 500 Startups. So I'm curious or eager to hear how the story has evolved since then. But maybe just give us the overview. What is Hustle Fund?
Yeah, certainly. So Hustle Fund is a venture capital firm that I started with two friends of mine almost 3 years ago. And we focus on what we call pre-seed investing. So the nomenclature around early stage investing these days is all kind of messed up. But what we mean by that is we're looking to invest in startups at the product stage. Founders have built some early version of a product, but may not actually have any revenue or traction. We don't care about that. And that's when we typically invest. And we invest across the United States, Canada, and more recently, we started investing in Southeast Asia.
Oh, okay. Interesting. So what led you to create Hustle Fund? You were, maybe give us the quick background, what you were doing before this and what inspired the idea.
Certainly. So many years ago, I was an entrepreneur myself. In fact, I had never thought about becoming an investor. I'm from the Silicon Valley. So for me, entrepreneurship was always the thing to do and continues to be so. But a few years ago, I was actually working at 500 Startups where I was a partner there and I ran their accelerator program. And I realized that actually there was this void in this quote pre-seed gap. And specifically, I saw that investors were interested in investing in companies when maybe you had a fair bit of revenue already, maybe $30,000 per month even, which obviously is not a super huge company, but it's something and certainly meaningful. And I felt like there was this real void for super early stage investing. I think the other thing I noticed is that, at 500 Startups, I observed so many founders and startups. In fact, I think I looked at over 20,000 decks while I was there and noticed that the kind of people who get funding at the super early stages of pre-seed tend to all fit a certain pattern where if you have a particular resume or from a certain location geographically, you may or may not have advantages. And for us, I just feel that actually that's not what is correlated with success in a startup. And we can certainly talk about that. And that was the problem that I wanted to solve. Like, how can we democratize pre-seed funding better? And so I see building this VC as building a startup in itself. It's just that our product is money.
Product is money. Let's talk about that pattern recognition a little bit, because it seems like the earlier you go, and you're obviously going about as early as you can go pretty much, how do you pick up signals? And I think that's maybe what you've identified, that a lot of these startups or a lot of these investors will look for patterns like where you went to school or where you worked as a proxy for who to invest in. But if you're not doing that, what patterns are you identifying, and how do you do that at an early stage? There's a lot in that question, but go for it.
I think the high level question is, how do you know who to invest in when a company basically has nothing?
Right.
And I think, frankly speaking, that is why there are not that many investors at this stage. A lot of people want to see some revenue, or a lot of investors want to see some revenue before they invest, because that is a signal that at least the company has done something, and generally in the right direction. For me, actually, at 500 Startups, we were investing in a lot of companies that already had revenue. And one of the interesting observations is that while that is certainly a signal that the founders can at least sell something and execute on something, it wasn't actually indicative of product market fit. Anybody these days can more or less sell something online. There are just so many ways you can get a buyer these days. But can you find a repeatable buyer? I think that actually those signals don't show up until much later. So a lot of investors, for whatever reason, get a lot of comfort around a little bit of revenue as opposed to no revenue. And for me, I felt like actually the real opportunity was to go in even earlier, where the valuations are earlier yet, or lower yet, I should say, but the risk actually is not any different.
Yeah.
So I think
Yeah.
that's the first thinking from an investor's lens of like, where can I find edge or opportunity in a market? And the multiples between what I would call pre-seed and seed are often, 2x difference, maybe 3x difference. And I just don't feel like it's justified to pay up. So then going to your actual question is like, all right, well, if you're going so early, then what signals are there at all? And I think there are signals. When I was working on the accelerator at 500 startups, I worked with, hundreds of teams.
Mm-hmm.
And the signals are not about, does the company have product market fit? I still have that risk on the table. Seed stage investors have that risk on the table. Even Series A investors still have that risk on the table. You're really mostly assessing team and some early opportunity around the market. And on the team side of things, you can get a good understanding of people in a few ways. One is how they execute, and speed is a big correlator with people's ability to execute well. Some of the best teams that I worked with while at 500 startups, they would set their own goal for next week, and then they would hit it. And they'd set another goal for the following week, and then they'd hit it. And when you think about it, if you just keep on moving your feet forward one at a time, then eventually you go someplace. Funny enough, actually, most teams cannot do that. Most teams cannot hit a goal or set a goal and then hit it for next week consistently. And there are many reasons why people can't hit it, like either they're distracted or doing too many things, or they're spread too thinly, or they're having co-founder issues. There are many reasons why a team may not be able to do that, but that is a good indicator. So when we do due diligence on companies, we ask a lot of questions about how are they actually executing. Even on a microscopic level, it's a very good indicator of team.
It's interesting. I agree with that thesis. It seems like you would need several months of data points though to be able to determine, can they do that? Can they set a goal, hit it, achieve it, exceed it on a repeatable basis? So how do you do this without watching 1,000 companies for 8 months each? Yeah.
So that was the other interesting observation. The accelerator program at 500 startups was 4 months long. But what was funny was that actually everybody on staff who was working with the companies was able to form an assessment about each team within just the first couple of weeks. And that opinion actually never changed for years.
Yeah.
In other words, your opinion about people and their ability to execute actually comes very early. And I think we see this in hiring. In fact, many companies hire folks on a contract basis first, whether it's for days or weeks, before deciding to make an offer. And that actually is a very good way to assess fit of a hire, even though the time period is short. You don't need to hire somebody for a whole year contract to know whether they're a great performer. And the same applies here as well, where you don't need to observe somebody for years on end to know whether they're a great executor. Now, there may be many other reasons why they cannot execute that are out of their control. Like maybe this is just not an opportunity. But you can certainly observe people and get a better understanding of how they work by observing them for just even 2 to 3 weeks.
Okay, interesting. Are there certain or common metrics you're seeing, goals and metrics that you are watching during that period? I mean, do most of the companies that are approaching you have the same, are they all, user additions or other means of traction, or like what's the commonality maybe?
There isn't any.
Okay.
Yeah. So that is unfortunate. I tried for years to figure out, is there a benchmark? I think a lot of people ask me that, like, oh, are you looking for a team to hit ABC milestone?
Right.
And I think the answer is no. So it is a bit subjective in that I think every company has a different set of milestones. So I think what we are looking for is, for the company that is, let's say, sitting in front of us at hand and we're talking with that company, what would we expect reasonable milestones to be? And are they getting close, or are they there or hitting them? And that, I think, stems from founder experience. But I think just as a very crude example, like if you compare an enterprise company might be years before they get a sale.
Yeah.
And then if you compare, I don't know, even an SMB B2B company, which is also B2B, you'd expect them potentially to be selling next week.
Yeah. Okay. Interesting. So what's your structure? Do you have a formal or sort of informal process for monitoring these folks? I noticed on the website you have sort of an application form. Is that correct, or what?
Yeah. So a few thoughts. So one is we invest in companies without monitoring them as a first pass.
Mm-hmm.
Like we will write a 25K investment check, and we try to assess as best as we can in the interview of how are they working. We ask a lot of just questions about how they work and how they think about things. And that's pretty typical to any other VC. I think where we deviate from other VCs is we can usually then make a decision after that conversation within 48 hours.
Okay.
So a company can get money quite quickly from us once they get to the interview stage. And then after that, we work with our companies closely on a growth project for 4 to 6 weeks. And in most cases, we won't be investing more money into the company. But in some occasional cases, we may. And that may happen 4 to 6 weeks later. It may happen months later. It may even happen well over a year later. And during that period, admittedly, that is when we get a lot more information about how teams work. But that may or may not lead to a future check in the near term or even in the long term. It really depends a lot on, case by case, since, as we just discussed, there aren't common benchmarks that we're looking for.
Okay. Let me see if I can recap that. So, like, entrepreneurs come to you, whether through your website or through referrals or other means, get into the interview. Fairly quickly, you can decide whether to write a 25K check. Is it always 25K, or is it kind of fluctuate? Is that sort of your...
It's always 25K for companies we have not worked with before.
Okay. And then the growth project, 4 to 6 weeks. And then what's typical check size next? And maybe talk about investing throughout the life cycle. Do you stop at the next juncture or what?
That's a great question. We typically only invest at what I would call the seed range. So basically pre-Series A. And so if we were to write another check, in most cases we are not, but if we were to write another check, it could be 100K, it could be 250K, it could be $500,000, it could be, maybe even up to $1 million, but that would be rather large for us. So I'd say typically around 250K, maybe up to 500K, which is our typical.
Okay. And that's still seed or pre-seed. I mean, you're not getting into the A's there.
Right.
That all makes sense. At that 25K, and maybe this is now approaching this from what we'll get to next, which is raising money for your fund and how you framed it and stuff like that. Are you doing a ton of those 25Ks, big top of the funnel, and, getting follow-on rights, and so you can kind of, carry on down the chain with others, or what?
Yeah. So I come from a high frequency investor background, at 500 Startups and many of the other accelerators. They invest in just a ton of companies. And so that's what I know and understand. And so we are investing a lot of 25K checks into many companies. I think on this fund, we'll invest in about 150, maybe up to 200 companies over the next, couple of years or so. So, at least writing 50 checks this year.
And can you share any benchmarks of the next stage of the funnel? Like what % of those go on to the next check, or is that proprietary?
Yeah, no, I mean, I think it really depends a lot. I think certainly less than 50% will get a subsequent check, but we hope at least 20% will get another check. But it really depends. It's not like we have a hard and fast rule of, 20% of our companies definitely need to make it. I think for each company, we're treating them differently, and we're looking at, what would we need to see to feel like the next level is de-risked. That's basically how we think about it. So the first level is we're trying to de-risk team. Next level is we're trying to de-risk a lot of things around market and customer acquisition. and every company has a different customer acquisition process, or a different starting point, or different whatever it is, different funnel. And so we have thoughts around, for each company, this is what we would want them to see if we were to write a second check. And I think just based on past experience, the 20% number, or at least we would like to see at least 20% of our companies get there, comes from just having seen lots and lots of companies and my portfolio at 500 startups.
Yeah, it's interesting. Let's carry on what you just started to say there for a minute, see if there's anything more to it, but kind of that framework of step one, de-risking the team. Number two, de-risking market and customer acquisition. Is there a step 3 and 4, or is it kind of those are the two things you need to get comfortable with?
Those are the two big things.
Yeah.
I mean, I think so many of the other things that VCs look for are pretty much captured in customer acquisition and market. Like, is there a real problem here? Well, that's a subjective question. That really boils down to what do the numbers look like. So,
okay. Well, let's shift gears, because this show is called How I Raised It, and we want to talk about how you raised your fund. How much do you have under management? And well, let's start with that question really quick first.
It's a good question. So I can't fully disclose that, but I can tell you our Fund 1 is an $11.5 million fund.
Okay. And then, go back to, you're at 500 startups, you have this idea, this thesis. Maybe give us the story of like, all right, I'm going to go do a fund here. How do you even get going once you've had this idea?
Yeah. So because I'm an entrepreneur at heart, and even after I sold my company in 2014, I was not thinking, oh, I'm going to go and become an investor. I was thinking, what is the next problem that I want to solve? Mm-hmm. And by being at 500 startups, I was, helping them look at companies and investing in companies. But I was also, just on a personal level, interested in what problems people were solving and what problems were out there. And along the way, I realized actually in venture capital, there's this big problem. And so that's kind of how I decided, well, I really want to focus my attention on what I call pre-seed, and try to find a better way to invest in pre-seed. And largely, I would say investors don't invest in pre-seed, but that was what I wanted to solve. Like, how can we solve the really, really early stage funding to make it just more fair for everyone, and also find signal where there generally isn't any. And so that's the problem that I set out to solve, and something I had been thinking about only once I got to 500 startups and was surrounded by all these companies and all these investors. But it wasn't anything I had thought about, years before.
Okay. So talk about leaving 500 and, how did you identify investors to back this vision that you have? Talk about raising that fund. Yeah.
So I had never raised money for a fund before. I had certainly raised money for my startup, but there's certainly a lot of similarities and differences. And one difference is that when you're raising money for a fund, it's not like there are lists or directories out there of investors in funds. And this is where I had to really learn to be creative, because with my startup, there were lots of lists and directories, right? Every VC is in a list or a directory. A lot of prolific angel investors in startups are also in lists or directories. And all of these people tweet a bunch and they write blog posts. So you know who to go to, know what list to build. I didn't. And so the way we did this was we started with our inner circle, basically friends and family, whom we thought could angel invest essentially in this fund. And we started there, and we actually even started with small checks. Like, our check size that we accepted for our Fund 1 was as low as $10,000. And on an $11.5 million fund, $10,000 doesn't go very far. Doesn't even fund one company. And we took a number of 25K checks as well. So we started with small amounts, and from there we got a number of our friends to invest, and from there we asked them for introductions to their friends. So we started spreading out our circle from there. And just for everyone we met with, even if they declined, we asked them, could they introduce us to, or could they think of one or two specific people who may be good to talk to about this? And the reason why I say one or two is that I found that if you ask, oh, well, if you happen to know anybody, would you mind introducing us? You're just not thought of. Like, people are like, okay, and they brush off that request. But
Sure.
everybody can think of one person. Like, your lawyer can probably be a good fit. Your dentist could be a good fit. Like, everybody knows one person of means who may be interested, even if you're not well connected. And so that was the premise that we started from. I think the second thing that we did was, from there, we noticed that some of our friends were a little bit nervous about introducing us to some of their more baller friends, like some of their more baller friends who are quite wealthy. Maybe they're billionaires, maybe they're famous, and get bombarded all the time. And I think in the US in particular, we're quite awkward about talking with money. Most people don't naturally talk with money, with other people. Like, most people don't share investment opportunities left and right unless you're in the super rich. And so I think it can be kind of awkward then to broker that introduction just out of the blue. And so a strategy that worked well for us to try to move upstream, if you will, was we held events.
Okay.
And the events were actually quite simple. Sometimes they were, simple dinners where we invited these people, our friends, who then invited some of their friends who were, more well-connected. And that helped. That helped with a soft sell, essentially, where we were not in a one-on-one coffee meeting, and it was not an awkward, specific brokering of an introduction for the purpose of investing, but rather we're inviting you to this event. And if you want to invest, great. But if not, just have a good time here. Other times, the events were even more casual or simple, just like a breakfast at somebody's house. And, the people who were invited just so happened to be good candidates for us. So that was how we went about it.
Yeah, that's interesting. That's a great, unique and different strategy. I want to drill into a little bit more. What was the theme of the dinner or breakfast? And like, what was in it for the ballers to show up?
Yeah. Well, we kept it very small. We actually kept all the events very small. And I think for us at Hustle Fund, like, we do have a mission of what we are trying to achieve. Of course, we would love to have a great, return on investment on this fund. I think it also aligns very well with our mission, which is we think that the way pre-seed investing is done, largely not done, but the way it's done is not very well and generally, quote, unfair. And we feel like if we have a better investing model, we will not only make money, but we hope to level the playing field, so to speak, in this category.
Interesting. How important do you think having a mission is for first-time funds? Because that's interesting. And now I can kind of see the hook there if I'm a billionaire, why I might want to at least hear about what you have to say about, it's unfair and stuff like that. Yeah.
Yeah. Well, I think that everybody has a different motivation for investing. And for us, we tried to come up with multiple storylines. All of them are true and all of them fit us, but they're all very different angles. So certainly the number one angle for everybody is just convincing people of the ROI of this fund.
Mm-hmm.
And that can kind of work, but I think it's actually very hard for emerging managers to get away with that, because if you don't have a track record, then, what is the evidence? But that is a story. The second story, for us at least, is around this leveling of the playing field. And that story was incredibly important to a subset of our investors, actually a pretty large subset of our investors, because they want to fund, maybe more women or more underrepresented minorities, or maybe broader swaths of the US or whatever it is. And that story really did appeal to people who are trying to do that either in their own personal angel investing or wanted to be able to do that, but just don't have the time to do their own angel investing. And so that was a big story.
Yeah.
And then there were just other stories as well, like, the third story is around differentiation of stage, where pretty much we can argue that there are not that many people investing at pre-seed. We have a handful of other friends who are, but beyond that handful, like, I cannot count 10 funds doing pre-seed in the US.
Yeah.
So differentiation of stage, people who wanted allocation really early. Another story is around, if you can get in that early, can we co-invest with you? Or can we, since you're not doing Series A, Can we take your pro rata at Series A? So there are all these like different angles, right? And people have different motivations, and we tried to basically assess for each potential investor which story would be most interesting to them.
Mm-hmm. Very interesting. Just to stick on this for one more second, what
Yep.
how would you actually do these dinners? Maybe actually like would you give a little talk or spiel, or would you follow up afterwards? How'd you
Oh,
work it?
definitely.
Yeah.
Yeah. So we would make sure to give a short talk, and it
Mhm.
wasn't too long to bore people. It was literally 5 to 10 minutes, but enough to give everyone a taste of the talking points. I mean, essentially it's an elevator pitch, and a true elevator pitch in an elevator might be 1 minute. This was like more like a demo day talk, really, 5 minutes or so. And then the call to action was, if you are interested in learning more about this on any level, we're always looking for collaborators, and we are raising money. So we would love to meet with you one-on-one. And that was how we essentially did some lead gen. And there were also people in the room at these dinners or breakfasts or whatever who were not either of means to do it or were not interested, but once they heard our story, they would think of somebody. And that was helpful too.
And just to get super granular, because so much of this show works because of the granularity, would you just give out your email address or hand out cards, or you're not scanning badges, of course, but like any like specificity for if they're interested, like getting them to take action? Because that's always, the hard part, right? Getting the drop off problem solved. Yeah.
Yeah. So I used to work in marketing many years ago before running my own startup. And one of the biggest simple things that my boss told me in the very beginning was always have a contact slide. And I find that very few people do. Like when you send your deck around, you should always have a contact slide. Don't just assume that anybody who has your deck has your email per se. And so we definitely had a call to action with our contact info in many different ways.
Okay, cool. How long did it take to raise Fund One? And if you can share, you're taking a lot of small checks. How many total LPs did you pull together?
Yeah, that's a great question. So I think one thing I should say is that for funds, there are nuances in the structure compared to raising money for a startup, in that if you have a VC fund that has a target of over $10 million, you actually only are allowed 99 investors.
Okay.
So therein lies a problem, because we, of course, would love to just take any check. As long as the check is big enough to cover our legal fees, we should just be taking any check. But after a while, we couldn't even afford to take a 25K check or 50K check, because when you think about it, let's say your target fund size is 10 million and you only have 99 slots, your average investor slot has to carry over $100,000 value. And so if you're taking too many 25K checks, that means you have to find investors who are willing to put in well more than 100K at that point. And so we needed to take enough small checks to build momentum, to show, oh, okay, we're closing really quickly. Now we've gone from starting this fund to now we have 100K signed to 500K signed, et cetera. And it was relatively easy for us to do the strategy to get to about $500,000, but then all of a sudden we had to be cognizant of number of slots.
Mm-hmm.
And so then we had to keep on raising the minimum, and that starts to become problematic, because you may be finding investors who want to invest, but they can only invest 25K. And so this is a problem that actually a lot of microfund managers have. I mean, the SEC has changed this rule for funds under 10 million, but if you want to raise a bigger fund, then you definitely have this problem. So that's setting up some context. And then in terms of time, we started the raise in the summer of 2017. And at first we were just getting people soft committed. We had our legal docs ready and filed by the end of September. And so at that point, we just got everybody who had soft committed in. And we did our first close then. I think there are many different opinions on this, but we opted to keep on doing many closes. I think traditionally funds have done 1 or 2 closes. We decided to break that, and we did, I want to say 4 closes. Just every time we got enough commits, let's do another close. And the downside to that is, of course, you're spending more money on your lawyer fees. But the upside to that is you are getting money locked in.
And so you would like, given if you can share numbers, great, but you could just give a sort of generalized answer, like as you're raising $10 million fund, as you're getting 2 million in commitments, you're doing a first close. Is that basically what you're saying?
Yes, exactly.
And you're collecting those checks, and you can start putting that money into startups at that point while you're also fundraising?
We were not collecting checks. So I think the other nuance between a fund and direct startup investing is when you sign with an investor to raise money for your startup, the investor signs and wires money more or less right away. With a fund, you do capital calls. And so we were just getting people signed where they were committing to, on a capital call schedule, wire their money over the next 3 years. And so even to this day, we still have capital calls to do from our investors on Fund 1.
Maybe then take the question as, what's the strategy of doing multiple closes if you can't start investing that money?
You can, if you decide to do a capital call right away.
Okay.
And we didn't do that with Fund 1. I think we waited a few months, maybe until, well, actually not even that long, I guess until October. I think we did our first capital call in October or thereabouts, early October. So it was fairly quick, but we didn't call down all the money. So for example, if somebody commits 100K and they sign the docs for 100K, we might do a capital call of, let's say, 10%, which means they'll be sending $10,000 at that time. But we would call the remaining 90,000 over the course of the next 3 years. There's a lot of strategy to that, and I won't bore you with the details, but basically every time you do a capital call is when the all the finance folks can start calculating the IRR, the return on the money at that point in time. So if you decide to call 100% of the money right away and it's all just sitting around, the clock is ticking and it's not earning any interest or anything because it's just sitting in your checking account, that doesn't look good for your fund. So people have all kinds of strategies of, okay, I'm only going to do a capital call when I need the money. But if you have a high frequency investment model like us, we would be calling money from you every day, which is annoying. So people have all kinds of strategies. But I think the point is, traditionally funds haven't done that many closes because the legal fees are rather high. And we decided that since we had heard so many stories from other emerging managers that investors tend to back out. And from my experience in running a startup, that happens a lot. Investors say they're going to invest, but then they don't. We decided we wanted to get everyone signed and closed.
Do you have even a rough rule of thumb or proxy for what percent of investors drop out? And I guess the other way to ask it is, how much should you sort of oversubscribe a fund knowing that there's going to be some dropout? Is there any rule of thumb?
No, but I have heard that in 2008 and 2009, there were a lot of dropouts. So I think that was sort of the other thing in 2017, which is funny to reflect back on now, but at the time people were saying, well, the recession is definitely coming this year or in 2018. So you need to get your money locked in right away. And in retrospect, that didn't happen. In fact, we went into even more of a bull market, but I think that the general mentality of just getting people signed and closed is really crucial before they, change their mind 6 months later.
Did you find any tips, or do you have any tips, or did you find anything that worked well to get people to close, kind of getting people over the hump? Yeah.
Well, momentum definitely helps. And so I think your other question was, how many LPs do we have? And what did that trajectory of closes look like? I actually have a graph of our closes on my blog. And I think, as you can imagine, if you were to draw that graph, like with any startup fundraise, most of the money was committed all at the end. In the last 6 to 8 weeks, I think over half of the fund was committed then. So maybe not quite half, but we were averaging about closing 1 million per month in the beginning. So we closed about 1 million in October, 1 million in November, et cetera. And then all at the end, like a barrage of money got closed. And so I think, you know, that's just human nature. People need FOMO and people need urgency and some impetus to close now. And so I think the more momentum you can show on it, the better. And I think the other thing with funds, using the 99 slots as an advantage, it certainly is a disadvantage, but as an advantage, you can then say, well, we are running out of slots.
Mm-hmm.
And
Yeah.
I don't know exactly how many investors we have in Fund 1. I haven't quite counted, but I think it is something like 70 investors.
Yeah, that's good. Good stuff. All right, really good. There's so much interesting stuff here. We'll link to that blog post in the footnotes for this, by the way. I think that'd be
Thank
good.
you.
What this is great. I guess just kind of looking forward now, what do you have to do are you thinking about Fund 2 already? Are you already starting to raise it? And like, what do you have to achieve or do to be able to raise another fund?
Yeah. So per SEC rules, we can't talk about our Fund 2 or
Yeah.
our future raises, but I can say that, of course, we're thinking about future funds. And I think, frankly speaking, like once you close a fund, you have to immediately start thinking about the next one. And that's what we did with our Fund 1. We closed our Fund 1 in end of May of 2018. So it took about 9 months to fully close our Fund 1. We did a lot of press around our Fund 1 afterwards, a few months afterwards, in order to start generating interest for Fund 2. And I think that's exactly what not only every fund has to do, but every startup has to do. You have to start thinking about the next raise, even if it's not going to be for a while, because I think building the relationships takes a while. And I think it takes even longer when you're talking about trying to raise larger checks. So I think if you know, in our Fund 1, we had a lot of small checks, but if you're thinking about a bigger fund, then you need your average check size to be bigger yet, because you're limited by the 99 slots, which means you have to start building relationships even more in advance.
Yeah. I know you can't talk about Fund 2, but any generalized tips for maybe someone else, a peer of yours that's also has a Fund 1 that's thinking about Fund 2? How do you start to build those, especially if you're going after maybe not angels and high net worth, but you know, proper LPs like institutions?
Actually, I don't think you can go after institutions in Fund 2 either.
Yeah.
I have heard from peer microfund managers that Fund 2 is the hardest fund to raise because you've exhausted your network for Fund 1. They generally are pretty tapped out to be able to invest in your Fund 2, or at least not a lot. And you're trying to raise a larger Fund 2, so you're looking for bigger checks from people you don't know, and you have no results or track record at that point either. So institutionals won't touch you. So it's something that we've thought about a lot. And actually, I think, you know, the world is filled with wealthy people and wealthy families. And so you're basically just going beyond your network to people with more and more money. And that just takes time to network out there and build trust and rapport. Make sure also you have the right fit. It's not just about us trying to find investors, but the other way around, like are they a good fit for us? And so it just takes time to build those relationships. So I think my number one piece of advice would be, if you've raised your Fund 1, great, congratulations. Take a 1-month break and then start your Fund 2 immediately. And that doesn't mean get your legal docs spinning. It means start building those relationships immediately.
Is that filled by family offices before you get to California teachers retirement, or what?
Yeah. Because I mean, when you think about it, and I don't blame them, right? Like the public utilities pension fund for California is not going to want to invest in my fund. And it makes total sense. Like, you know, when grandma wants to retire, like, you want the money to be there. You don't want some doofus microfund manager to have lost the money. So that makes total sense. But what that means is, like, for somebody like me, if I don't have that liquid track record, I have to go to other sources, people who are willing to take risk. And they tend to be wealthy individuals or wealthy families who, you know, have some level of appetite for risk. And not every wealthy person wants to take risk. In fact, some people feel like, well, I am so wealthy, I definitely want to be conserving money. I don't want to be putting my money in crazy things. And other people feel like, I don't have enough money, I want to take a lot of risk. And trying to suss out who is, I think, the part that is time consuming, because you don't know what people's interests are before you meet with them.
Yeah, that's interesting. That's great. Very good. And, again, you can't comment about fund too, but is your thesis evolving just in general? Like, how is your thesis evolving, if at all?
Our thesis stays very much the same, and I think it will continue to stay the same for hopefully many funds.
Cool. Awesome.
I think there's certainly some nuances that have changed. And I think certainly with a larger fund, then you're also changing the amount slightly. Mm-hmm. But the thesis and the stage, the geographies and all of that stays the same.
Cool. All right, let's just talk. So for any founders that are watching this, which is probably most of our audience, how do you like them to approach you? Should they find the referral? Should they apply through the website? What else should they know?
Any and all of the above. So we're an open book. I respond to almost all cold emails. If I see them, I'll respond. And I'll also respond to warm referrals too. So it doesn't really matter. You don't have to be well connected, or you could be well connected. It doesn't matter. And for both groups of people, I will just actually encourage everybody to then fill out an application once they do email me. So everybody literally goes through the same stream. And so that way we look at everything in the same manner and consistently. After the application, every application gets a response of some sort. And unfortunately, I think that's where we're slowest. If I had to pick out like a weak point in our system, we are quite slow in responding, but on average, it takes us about 2 weeks to a month, depending on where we are.
Okay.
And so that's what I would say. But one of the things is, if you ping us and, if you cold email me and say, hey, just wanted to see where we are with the application, I'll definitely respond to that. And very often I will prioritize those founders who have the hustle to do that and look at their application ahead of time. So that is sort of a secret thing that I'm sharing with your audience that actually I haven't said before to anybody.
Okay. You're encouraging them to be naggy, which that's part of hustle, right? Yeah.
I think follow-up's very important. I mean, one of our investors for Fund 1, we had a good meeting with him, but then he didn't respond to our follow-up email. And my business partner then followed up with him another 12 times before we heard from him. And then he invested.
Wow.
And so
12 times.
No response is not a no. I think, sometimes people get busy and it may have actually nothing to do with you. Like right now, it's actually tax season, and taxes and audits are very cumbersome for funds, and they take a lot of time. Like it's actually very different being an angel investor compared to a fund, because there are a lot of administrative things you have to do in running a fund, and people just don't know. Like we have spent an inordinate amount of time on taxes and audits.
Yeah, interesting. I've always said like follow up 3 times and then give up, but 12 times, I guess that's the new bar. Well, very good, Elizabeth. This is great. So hustlefund.vc. Anything else you want to point out? We'll link to the blog, but any other things you want to plug?
No, I mean, I think, hustlefund.vc is where you can apply. We also do a lot of content. So, you can certainly check out my blog at elizabethyin.com. And this is actually where I've written an article about how we raised our Fund 1.
Okay, great. We'll link to that. Are you still doing the dinners, or starting to do dinners again? I think
I can't comment on that, but I would say it is a good strategy.
Yeah, great. All right. Thank you so much. This is great. Good luck with Hustle Fund, and hopefully the seed and pre-seed market stays strong for a little while longer.
Well, great companies are always funded, and even if they're not funded, actually always, come about from recessions as well. I think every day is a good day to be building a business if it's the right opportunity.
I agree with you, and I'm going to put out a blast to Founders Week customers, kind of saying that same thing, like, hey, we could be in for some rocky days ahead, but like, you could come out stronger on the other side. A lot of great companies have been formed in a downturn. And, there's a Darwinian effect, right? The strong survive. So get out there and be strong and ramp up your hustle. That's what I was thinking at the gym yesterday. So I'm going to put that into a newsletter. Yeah.
Yeah. And one last thought on that. I mean, I think people always think, oh, how can I raise money or whatever? But actually, sometimes not either being able to raise money or not raising money turns out to be a great thing. Like one of our portfolio companies, which my business partner invested in at the very early stages, called NerdWallet, has done phenomenally well. They've been largely bootstrapped, and they started actually during the last recession. And the reason they're bootstrapped is not really by choice. It's just that nobody would fund them. And at this point, the founders own so much of the business because they were not able to raise that much money or not for a long time. And so the business is actually quite incredible now. Like in retrospect, I'm sure the founders are absolutely thrilled that they didn't sell their equity because it was a lot of work certainly in the beginning without a lot of cash, but they made some very wise decisions on the cash front, and now they own a phenomenal business.
That's awesome. That's good. That's inspiring. All right, thank you very much. Appreciate it, and we'll catch you at another juncture. Hopefully, have a good rest of your week.
Yeah, thank you, Nathan. You too.
Bye.